In this video, we're going to discuss the difference between income tax expense and income tax payable. So income tax expense represents all taxes that are accrued during the current period. So the current year, whatever income taxes are accrued, it doesn't matter when the payment is actually going to be due. If it's accrued during the period using accrual accounting, then it's going to be booked to income tax expense. Now, income tax payable, on the other hand, generally represents taxes that are going to be due within the next year. So if it's due within 1 year or the operating cycle, whichever is longer, it's going to be a current liability. It's going to be income tax payable. So this is the actual check that the firm's going to need to write to the government in the next year. So I want to give you an example. It'll make it a little easier to understand. So let's say that you're a landlord and you rent out a house to a guy named Standing Bear, and so he's going to take this house and he's going to make it a hostel for Appalachian Trail thru hikers. And so you rent him this house and you charge Standing Bear $3,000 a month rent. Okay? Now, let's say your tax rate, and so your tax rate is going to be 35%. And so we're going to figure out your income tax expense and your income tax payable for this first year. So let's say that your income statement, so this is now we're thinking about book income, financial reporting. So your income statement for, let's say this year is 2027, your revenue is $36,000, because let's assume that he makes 13 payments in 2027. So that's actually $39,000. But if you remember from accrual accounting, and we think about revenue recognition for book purposes, you only recognize 12 months of rent, right? So 12 times 3,000 would be you recognize $36,000 of revenue. Now you've got expenses of $20,000. That leads to pre-tax financial income of $16,000, assuming a tax rate of 35%. Income tax expense. And I'm going to put a little income. Make sure you understand this is the income tax expense is $5,600 for this period. How is that different from taxable income? Well, we've got an issue here with the timing. So note that I said Standing Bear made 13 payments to you of $3,000 per month, and there's only 12 months in a year. So what that means is, let's say that toward the end of December, he made January's payment for 2028. Right, so he made that 2028 payment early, right? Toward the end of December, he paid you for January of the next year. Now, for accrual accounting, for purposes of financial statements, income statement, we only recognize revenue when it's been earned, right? And he's only lived in or used this house for 12 months, so it's $36,000 revenue. But for tax purposes, there's a difference. There's a thing called a temporary difference, which we talked about in another video. There's a temporary difference, which is going to lead to a difference of timing, because with taxable, with IRS, you recognize that rent revenue when you receive it, not necessarily when it's been earned. So he paid you that extra payment of $3,000, and so for 2027, that's going to be recognized in revenue. So we're going to have $39,000 in tax, right, in terms of the revenue for tax reporting, whereas it was $36,000 for 2027, right? So this is $39,000 minus 36 is $3,000. That's that extra payment that he made, right? So that's going to be taxed immediately when you receive the money. And then so you got expenses still at $20,000, taxable income of $19,000, right? Instead of pre-tax income of $16,000. There's a $3,000 difference. You're recognizing that $3,000 immediately for tax purposes. Same tax rate, but our tax payable is $6,650. So, and that's our income tax payable. So now you notice here that we've got a difference. Income tax expense is $5,600, right? But income tax payable is $6,650, right? It's because you recognized that extra $3,000 in rent. That would be unearned revenue for purposes of financial statements, right? It'd be a liability on the balance sheet. But for taxes, you get taxed on it immediately. Let me show you the journal entry, so it'll make it a little bit easier for you to understand here. So what we're going to do is we're going to debit for 2027. We're going to debit income tax expense. I'm just going to abbreviate here. Income tax expense we're going to debit for $5,600. Right? I just got that from right here. Now we're going to debit. Well, let me show you the credit first. So we're going to have income tax payable, right? So we're going to have, we're going to have income tax payable of $66.50. Right, so it's going to be a current liability. So $66.50 represents the actual check we're going to have to cut to the government, right? Now we've got a problem here because we see that to make the debits and credits balance, the left and the right side balance, we need a debit here, a plug of $1,050. So what is that? That's going to be deferred tax expense, or a deferred tax asset, excuse me. Deferred tax asset. So that refers to the fact that we basically prepaid a little bit of our tax here, right? Based on that extra $3,000 times the 35%, right? That's what this $1,050 is. And I've got a video on deferred tax assets you can check out. But so that $1,050 we've got, and that's a future economic benefit because our taxes will be lower in the future. But you see, there's a difference. Our income tax expense is lower than the actual check that we're cutting to the government. And the reason is that for tax purposes, we end up recognizing this revenue, even though we haven't earned it yet, for book purposes, right? So that's the nature of the difference. I'm just going to show you. This will actually reverse this temporary difference. So I want to show you. So let's say for book purposes, in 2028, it's going to be $36,000, and then $20,000 expenses, and then $16,000 pre-tax income. 35% rate is going to give us, where in 2028 the income tax expense would again be $5,600. But let's assume for 2028, for tax purposes, that Standing Bear then makes 11 months payment, right? So he made basically over 2 years he's going to make you 24 payments, right? So let's say that in 2028 he makes 11 payments, and so he basically made 13 payments in 2027. And then 11 payments in 2028. So now your revenue is going to be for 2028 for tax purposes $33,000, right? So $33,000, and then let's keep the expenses the same. So now our taxable income is going to be $13,000, and then assume tax rate of 35%. Income tax payable now is going to be $4,550. Now in this case, see that income tax payable for 2028 is actually lower than what income tax expense is for 2028. Okay, so now it's what it has happened is the temporary difference, this timing difference, has reversed. So now I want to show you the journal entry here. So now we'd have income tax expense is again going to be $5,600. Right, this is again going to be $5,600, and our income tax payable, we're going to have a credit. Because we're increasing a liability account. This is a current liability. Income tax payable is going to be $4,550. Okay. Now notice that to make our left and right side balance, we need something here. So we're going to have, this is going to be $1,050. Same as our deferred tax asset before, but this time we're crediting the deferred tax asset. We're reducing it. Okay, so what it is basically this deferred tax asset, if we were to look at a T account, we had debited it in 2027, and now we credit it in 2028. So now the deferred tax asset is off the books.